It's March 31st, and this is the last update of the month. I'm going to lead off with the SOX, the Philly Semiconductor Index. As you can see, we put in a head and shoulders bottom, and it appears that the wave progression lends itself to a 5-wave. The 5th wave, it appears, is headed towards the most common projection for a 5-wave move, and that is the 61.8% projection, meaning the total distance from the bottom of wave 1 to the top of wave 3, projected from the bottom of wave 4, the 61.8% projection, gets you up to right here, and that 61.8 projection for wave 5 coincides almost perfectly with the 61.8% retracement of the entire decline. Upon the completion of an A, B, and C pattern, an ABC, a zigzag, it is not at all uncommon for the first rally to reach the span of the B wave, and that's precisely what I'm expecting right here. Should this first 5-wave move come true, and we'll know very soon as today or tomorrow, it would be the first clue that the bottom is in. But just like all first rallies, meaning the first rally off a bottom, this rally will also be disbelieved, and that's one of the characteristics of a first wave. 1, 2, 3, 4, 5. We're going to call this wave 1 of a bull market, new bull market. So this rally will be disbelieved and will give way to wave 2, which might get as low as here at some point. And this in turn will give you the best buying opportunity since the end of the red C wave. And if this shall come true also, the ensuing rally will be the most powerful. That would be wave 3. All right. As far as the S&P 500, the pattern in play is not exactly what I just discussed as far as the SOX is concerned. What the S&P 500 is tracing out is a double zigzag, it seems to me. ABC X ABC. And as I said, it's March 31st, 6 o'clock or so. And you can tell the futures are up because we're now in the final phase, I believe, the C wave, targeting about 2740 on the S&P 500. This would be the objective of the C wave, and according to my valuation model, the fair value is somewhere in the mid 2700s. What do I mean by fair value? Again, according to the valuation model, at the top of the bull market in February, the valuation model suggested that the S&P has overshot to the upside by 22%. And the same valuation model suggested that at the bottom last week, the March bottom, the S&P overshot to the downside by 22%. Fair value is right in between, which puts us somewhere in the mid 2700s. So if this is the end of a counter trend rally, ABCX ABC, does that imply that the S&P 500 is going to make new lows? And the answer is not, because the first decline was an A and a B and a C, just like the SOX. And this rally is a double zigzag. We're going to call this wave X. Okay? And what I am expecting is the next phase of the bear market to unfold as a wait and see triangle. Okay? 3 attempts at breaking below the C wave, and I'm predicting right now that these 3 attempts will form a triangle, and this triangle will fail to breach the C wave, meaning it will hold above the March low. ABCX, A, B, C, D, and E. This is exactly when I expect the whole bear market to end. It will end at a higher low, and then it should usher in a new bull market just in time for the SOX, which I just discussed, just in time for the SOX to begin its 3rd wave. All right. Next. So why do I think it's 2740 on the S&P other than the valuation model suggesting 2740? Is there another reason for 2740? If you go back to 2018, we had a head and shoulders. The blue line is that neckline, is the neckline of that head and shoulders. And that neckline actually, let me see if I can go back one chart. Okay, that neckline right here on the right, that's the daily chart, actually posed as support for 3 consecutive days in March, as you can see, before we finally broke below it. So right now, why did it pose as support? Why did we find support right here? Because, not only because this neckline is support, it's because fair value, according to the valuation model, is right there. And so right now, this C wave is headed, it appears to me, towards the 127.2% extension of the A wave or projection, okay, of the A wave to complete the second zigzag, ABCX ABC. The C wave, in my opinion, will end right here, setting the stage for what I told you before, A, B, C, D, E, the triangle. Why is the bear market not over? Because right now the S&P 500 is looking to assume a neutral stance. I call that a no growth stance, meaning we're headed towards a place of neither an earnings recession nor an earnings growth, okay? Because you know what the S&P earnings forward estimates were prior to this crisis. They were up there. Everybody was calling for S&P to reach 3,600, 3,700, 3,800, when in fact I had been warning for a while that this whole thing is about to end and usher in a bear market. So again, right here, it overshot by 22% up there, where it was in February at 3,800. I'm sorry, 3,380, almost 3,400. It was plus 22% overvalued. Here, minus 22%. Right here at the neckline, it's 0%, meaning a no growth scenario. But we know that there's going to be some sort of an earnings recession. So ahead of the earnings season, the S&P 500 is assuming a neutral stance until the companies will start coming out of the woodwork, reporting and guiding lower. All right. So again, our objective for this rally is the neckline. Now, the other thing about the S&P 500 is the DeMark count. We had a TD, meaning Tom DeMark, TD sell setup 9 right here. In fact, this turned out to be 10, 11, 13. I'm sorry, 10, 11, 12, meaning TD setup extended beyond the minimum of 9 consecutive bars, whereby each bar closed below the closing price of 4 bars earlier, meaning every bar here closed below the closing price 4 bars earlier. This one right here, 1, 2, 3, 4. This one closed below this bar. The one before it, this green one, closed 1, 2, 3, 4 below the closing price of this bar. We had 9 consecutive ones and we got 3 extra, so it extended a little further. That was a TD setup by that extended to 12. Okay, and then we got a bullish price flip, meaning when we gapped up right here, see that gap? Actually, the gap is from where we closed on Monday, last week, Monday, up to where we opened, or the low for that day, which happened to be the open also. That whole thing is the gap. So this gap, this up gap, tells you what? That prices down there were completely rejected. No one wants to trade down here because clearly the market overshot, okay? And that's why we got the gap up. At the same time, that first day, on the back of that low last Monday, recorded or registered a bullish price flip, meaning that's the first bar right here to close higher than the closing price 4 bars earlier. 1, 2, 3, 4. We closed above the closing price of bar number 9. The next one here, bar number 2, closed above the closing price 4 bars earlier. 1, 2, 3, 4. The green one right here, so on and so forth. So currently we are on bar number 5 as of as of yesterday, Monday. Bar number 5 closed above 1, 2, 3, 4. This bar, meaning last Tuesday, and that close above last Tuesday's close made it bar number 5. So how many are we looking for before possibly ending at 2740 and turning back down? You guessed it, we're looking for a minimum of 9 bars. So as of Monday, yesterday, that was bar number 5. 4 more days puts us at bar number 9 this Friday. So I am expecting to reach 2740 by no later than Friday this week. Okay? And I'm looking for it to coincide with, again, 2740 somewhere here. Somewhere here. In this range, meaning the open gap, maybe a little higher. I don't know. We'll see. All right. The Russell 2000, and if you're trading it, you're probably trading the IWM, also appears to be tracing out a 5-wave rally like the SOX. And so if you see it make a new high relative to last week's recovery high, okay, if we break above this level right here, I don't know, it's about 117 and some change. We break above this, meaning last week's high. We're headed towards where? This area. We're going to fill this gap. The moment we get above this right here, meaning this empty space, this will act like a hot air balloon, and it will head towards 124, 125 to possibly fill the gap or come ever so close to filling it and completing the 5th wave. Everyone is going to refer to this as a bear market rally. Again, why? Because the first rally off the bottom is wave 1 of the new bull market. And this wave 1, like all first waves, will be disbelieved, leading to a sell-off, meaning book the profit, sell whatever news, maybe we'll have some news, sell the news, lock in the profits because we're headed lower, when in fact, if this is truly a 5-wave, we are not headed lower. A 5-wave is evident on the chart. The bottom is in, and the second wave will retrace up to 100% of the first wave, not to breach the low, and it sets the stage for the 3rd wave. We're not talking days here. We're talking maybe weeks, months, maybe. Why? I'll discuss that in a minute. This is not a pullback in an ongoing bull market. This is a bona fide bear market, similar to what happened in 2008. In fact, the two sell-offs, the two bear markets go hand in hand from a trend and cycle perspective, as I will discuss in a minute. All right. Spread, I'm going to talk about yield spread, meaning the yield differential between treasuries and corporate bonds. Look, if I have money, I want to invest in bonds, and I have two choices. I either buy treasuries, government, or government bonds, which are perfectly safe, guaranteed to safeguard my money, or I buy the riskier corporate bonds that pay a higher yield. Now, we've had a credit crunch here recently. The Fed came to the rescue. The government came to the rescue, so we have a horde of fiscal and monetary measures. And because of that credit crunch, what happened to corporate bonds? They practically crashed, leading their yields to skyrocket. Why? Because if there's a credit crunch, you think I'm going to lend my money to a corporation to continue to finance its operation and risk defaults and not get my money back if they want to borrow money from me by selling me their bonds, well, that bond had better be low priced and the yield will have to be very high to account for the risk, the outsized risk that I'm taking. So you want to borrow from me some money by selling me bonds, you had better pay me a lofty yield to justify the risk that I'm taking. So um, the nice thing about it is that now the yield, the corporate yield, is coming down faster than the treasury yield. So the ratio of treasury yields to corporate yield is falling fast, which means that the credit crunch is slowly easing, and that's good for stocks. Are we out of the woods yet? No, we're not. But at some point, I expect we will be. All right. Here is the SHYG corporate bonds. You can also use HYG, and you will see how far down this thing came. I mean, basically, corporate bonds crashed, causing their yield to skyrocket, meaning you want to borrow money from me, you want me to lend you money by buying your bonds, the yield had better be high enough to justify the risk that I'm taking. And so you got to keep an eye on that particular metric whenever you are assessing the risk taking conditions in the stock market. All right. Next, let's talk long term for a second. Here's the S&P 500 since the 2009 bottom. Recall the forecast. I said 1, 2, 3, 4, 5, and then we're going to come down, test the fourth wave, maybe lower. I said, and that's exactly, you got the maybe lower. Okay, in effect, we erased the entire Trump rally. It was a poetic move because the president had boasted all along about the all-time highs in the stock market, and the market responded by saying no more. Of course, it was cycles at play. It had nothing to do with the president or Wall Street. It's just a black swan, a catalyst that triggered the bear market on the heels of the end of the five-wave cycle. Now, let me show you something here. And I said all along, this is a normal correction to a technician who practices Elliott wave. A normal correction, five-wave rally, you get a pullback. And of course, it feels more dramatic than this because it's at the end of a 11-year cycle. Okay? In fact, this right here was the summer 2011 swoon. It's a blip on the radar. Even the 2010 crash, same thing. And even this. So the higher we got, the more pronounced the sell-offs became. Okay? And that's why this one here since 2009 was the most pronounced, the severest, the most severe of all. Okay? All right. So, again, five-wave rally. Where does this whole five-wave rally fit into the grand picture? And that's what I'm going to talk about next. This five-wave rally, believe it or not, is the third wave rally This is March 2009 through February 2020. This whole five-wave rally is the third wave of the supercycle that began 150 years ago or more, meaning we're starting from near zero, and all the industrial and the technological progress led to a boom, one boom after the other. You had, of course, occasional busts along the way, but in the end, we reached a 1500 level on the S&P just in time for the dot-com bubble popping, leading to wave A, the stimulative rally, or the rally on the heels of the dot-com bubble burst, stimulated by the Fed, which led to the B wave retesting the high of the first wave, and then the financial crisis, which led us to retest the A wave. So in effect, what we got was an A, B, and a C, 9 years, a full decade almost, of sideways action, no progress. And that's what a second wave, that's what the second wave of this super cycle unfolded as, an A and a B and a C, setting the stage for an exhilarating rally, wave 3. And now we got the sharp fourth wave. And that is why I wanted to talk a little more about this, because there's something we call the principle of alternation, meaning if wave 2 is sideways, wave 4 is a sharp decline. If wave 2 is a sharp decline, the fourth wave is sideways. So we got that sharp decline. We retraced 50% of the 11-year-long bull market in a matter of 4 weeks. Okay? Very dramatic. Now, I'm expecting, as I said before, this rally here to end, the X wave, setting the stage for a wait-and-see triangle from where a new bull market will emerge. But I must warn you right now that this final rally over the next 2, 3, 4, 5 years, I don't know how long it'll take, this fifth wave will bring the super cycle to an end and will usher in a crash worse than what we just saw. This will be this will be 50% retracement of the entire five-wave bull run, the super cycle, and there's no telling whether we'll stop right here or we'll head even lower. Why do I say this? Because when wave 3 is confirmed, it's easy to estimate the downside of wave 4 in an ongoing 5-wave rally. Remember, the super cycle is not done yet. So when the third wave is done, it's easy to estimate, relatively easy to estimate the downside of the fourth wave, because you know that there's something called alternation. If wave 2 is deep, wave 4 will be relatively shallow. So wave 2 was around 50%. Wave 4 was around 50% relative to wave 3. Actually, it was a little over, right about there, 44%. So we'll call that roughly 50%. So the fourth wave isn't coming down here. We know that because it cannot exceed, or it cannot breach this area. Okay? The zone of wave 2, this right here, cannot be breached. And typically, 90% of the time, the fourth wave does not exceed a 50% retracement of wave three. So here, it was a typical fourth wave that retraced 50% or almost 50% of wave three. And that was good because it was predictable. We know where the fourth wave was going to end. It was going to end in the vicinity of the prior fourth wave, sometimes a little higher, sometimes a little lower. But it ended exactly where I had predicted it would end from a range perspective. My range was 2198 to 2030, and I believe we bottomed around 2180. All right, now here's the thing. Once the fifth wave comes to an end, meaning the super cycle, 1, 2, 3, 4, 5, well, how much will the downside be? Because remember, this fifth wave isn't the third wave of a much larger bull market. Just like this decline here was the fourth wave of an ongoing bull market. Here, the bull market is going to end. There's no telling how much of this five-wave super cycle will be given back. How the extent of the crash will be unknown. That's why I'm warning you to prepare for this, okay? Because what did my forecast say back in June 2019? That upon reaching the 3,400 area, give or take, we're going to come back down and revisit the prior fourth wave. That's what I said. For reasons yet to be known. We didn't know what the reason was. Now we do. Okay? And the COVID-19 could have been just the catalyst that triggered this bear market. There could be some structural things going on with the economy that no one's talking about. And the COVID-19 was simply the catalyst. But again, the Fed and the government, with all these stimulative measures, they're buying us more time. And because all these measures are stimulative for stocks, we're going to see the ignition of the fifth wave at some point. Okay. But again, I can't warn you enough, upon the completion of the super cycle, five-wave move, we're going to be up against some real tough times for which I urge you to prepare and not be complacent. All right. Now, how did I piece all this data? Because, the S&P 500 didn't get introduced until the 1950s. So how could I have gone all the way back to 1871, if you might ask? Prior to the S&P 500, there was the S&P 30. And prior to the S&P 30, there's data from the economist Alfred Coles, who kept track of stock data going back to the 1870s. So we pieced it all together to come up with this forecast. All right. Next chart is the transports. You know that the transports, this bear market in the transports actually began in late 2018. That was the high in the transports in September, October 2018, right in, Q3, Q4. And then it embarked on a bear market that didn't end until just recently upon the testing of the fourth wave again. So the five wave in the transports ended 15 months ago, okay? The bear market in the transports has been ongoing for 15 months. And typically what happens, we retest the fourth wave a little higher or a little lower. Here it was almost perfect. Okay? So what does that mean? It means that as far-fetched as it seems right now, we're going to head back up. Okay? We're going to head back up and make new highs at some point. It won't be tomorrow, no, it won't be next week or next month. It'll be a few years from now. We'll see how fast it'll happen. But I want to remind you that this here was the canary in the coal mine. Actually, this here, right here. Why? Because all the broad indices that we watch, S&P 500, the NASDAQ, the SOX, everything was making new highs. And in euphoric fashion, by the way, in some cases, Apple and some stocks were just running crazy. So when the broad indices, the most common ones that we watch, like again, the S&P, the NASDAQ, the SOX, when these guys, and the Dow Jones, of course, when the Dow Jones makes new highs and the transports fail to do the same, this is a Dow theory non-confirmation of the rally. So we've been making new highs. The transports are singing a different tune. Finally, the cord had to snap because the bearish divergences reached intolerable levels. Now, I want to talk about something similar that happened in 2014, 2015. The transports printed a high in October 2014 and then began to decline. And while the transports were on a decline, what were the S&P 500, the Dow, the NASDAQ, and the SOX, what were these guys doing? They were actually rallying to new highs until the cord finally snapped around, I think it might have been June or July 2015. You know, the market said, enough's enough. You guys are rallying to new highs, but the transports are not. So finally, the string snapped. Everything came down, crashing in summer 2015. We had a relief rally for the rest of 2015 and then came back down and put in a final low in February 2016. All the indices bottomed right around then. And then what happened? The transports traced out a head and shoulders continuation pattern. And when the transports finally broke above the neckline, we had an exhilarating rally in 2016, 17, 18. So everything was being confirmed by the transports. Okay? Unlike here. Here, at first, we thought there was some sort of a continuation base with an upsloping neckline. But when did everything come down? When did everything come down crashing? Upon testing the underside of this neckline here in January. Actually, it might have been December. I don't recall exactly. And that right here marked the beginning of the bear market for the rest of the indices, And that's exactly what we're going to be looking for along the way. Those types of bearish divergences will tell us when the fifth wave has finally ended. So we'll remember that for years to come. All right. So here's the SPX again. And actually, let me go back one. Where was I? That's the transports. Okay. So the transports. Here is their super cycle. Here's the super cycle in the transports, just like what I showed you in the S&P. Uh, super cycle began way back there, a couple of centuries ago, and we traced out a fifth wave or a five-wave rally, 1, 2, 3, 4, 5, that ended the first wave in 2000, came down crashing. Actually, sorry. Yeah, one, uh, probably one somewhere here. I never really bothered looking. It's probably before getting here. It's probably 1, 2, 3, 4, and 5. And the five-wave super cycle, meaning the first wave in the transports, ended in 2007, just ahead of the financial crisis. So again, 1, 2, 3, 4, 5. That's wave one, financial crisis. Wave two, 2009, ushered in the third wave, the start of the third wave. And as you can see, the third wave relative to the first ended right around 161.8%, meaning the size of the third wave amounted to roughly 161.8% the size of wave one. And you can tell that in early 2018, January 2018, the transports tried to take out the 161.8% and they failed. And then later on in the year, they managed to close 1/4 above the 161.8%. Late 2018 decline, climactic decline, and then 2019 we tested that same 161.8% level, trying to take it out, and failed miserably. Okay? So it's always good to step back and look at the big picture to understand what's going on. Okay, because you don't want to look at the noise. The noise is fairly, pretty meaningless. But when you look at it from take a forest view, a bird's eye view of what's going on, you'll be able to put a narrative on it like you wouldn't believe. And that's exactly what I said. In early 2018, we got here. And we experienced that sell-off in early 2018, marginal new high in 2018, came down crashing in late 2018, rallied for a full year to retest that same level, and then came down crashing even harder. So in effect, you have an ABC bear market in the transports. All right, enough of that. That's the quarterly. So what did I say before? Beware the fifth wave, which once it ends is going to bring about the biggest crash we've ever seen, because no bigger crash than the one that comes on the heels of a super cycle 5-wave move. Okay, on to the Dow Jones Industrial Average. Super cycle wave 3, 1, 2, 3, 4, and 5. This is the third wave in the super cycle, ushered in the fourth wave of the super cycle, which exceeded the prior fourth wave, came all the way back down to test the line drawn across the 2000 and the 2018 swing highs. That's the top of the broadening formation. We tested it right on the head. We hit it right on the head right here. Okay? And this is what helped me last week to call the bottom in the indices. And so far so good. We've had a real nice bounce off the bottom. Are we going to come back down and test? I think so. We're having a rally right now, and then we're going to have some chop right. It's going to be a range-bound sideways move, aiming to test the lows before finally igniting the fifth wave, sort of like the S&P 500. Okay? So let's take a bird's eye view of the supercycle. Okay? Next is the supercycle. Here it is. And it's actually jaw-dropping when you see how the first wave ended in 2007, 2008, leading or ushering in the second wave thanks to the financial crisis. And then look at the third wave. It practically got to 161.8%, the size of wave one. You know, I mean, you have that invisible hand at work that's keeping track of all that when the majority of us don't even see it. You know, you have stupid anchors and on CNBC mocking all these ABC moves and all this and that. They're claiming that this whole sell-off was due to someone seeing an ABC coming to completion. No one talks about the Dow theory, non-confirmation, and they think that all these ABC moves and these 1, 2, 3, 4, 5 moves, that they just started happening when the algos came into the scene, when in fact all these patterns are time-tested, time-honored, and they date back to the beginning of time as far as the stock market is concerned. So let them laugh, because when this fifth wave comes to an end, they will be the least to know what's going on. All right, so 1, 2, 3, 4. The fourth wave tested or actually reached the 50% retracement of the third wave, just like the second wave did too. The second wave, you see it? It retraced 50% of the first wave. Now, some people might say this is the ABC, it's an expanded flat. I don't think so. That wasn't an expanded flat. The first wave in the Dow, unlike the S&P, whose first wave was here, the Dow's first wave was at the height of the market headed into the financial crisis, heading into the financial crisis. So 1, 2, 3, 4, 5, you see the third wave reaching 161.8%, the fourth wave retracing 50% of the third wave, just like the second wave did. So now if my forecast, should my first forecast come true, you're going to see the S&P, the Dow Jones reach 35 to 36,000 in the coming years before we succumb to the largest and deadliest and most dramatic bear market we've ever seen. Full-fledged depression, in my opinion. We'll see how it goes. I could be completely off base. The socks, my favorite. When did I identify this massive cup? I identified it right here. Right here, actually, if I recall correctly. Somewhere in 2013. I saw that what's happening is there's a slowly brewing cup and handle. And when I analyzed the correction that began in 2000, okay, correction began in 2000, ended in 2009, this whole correction, what stood out is this triangle right here from 2000 and I don't know, 4 through 2007. And anyone knows that the sell-off or the decline that comes on the heels of a triangle is usually the last. And when I saw this, I realized that a new bull market was born in 2009, and we saw what happened since. The rest is history. Now, look, we had a cup and a handle. This was the correction in 2018. A cup and a handle. The correction was the handle. Now, once you break out of a pattern that's been forming for 20 years, don't you expect the breakout to be back tested? Absolutely. So this whole thing, this COVID-19 drama, and I don't want to sound insensitive to what's going on, but from a technical standpoint, it was an opportunity to backtest the breakout area before we head up towards as high as 2,600, in my opinion. We got close to, look, this is a forecast. It's not after the fact. That was the fifth wave target zone that I set when we were down here. We got right in the middle of it, almost got to 2,000 on the SOX. It got decimated, 37% pullback, and now I'm calling for it to go to 2,600, which is the measured move of this cup and handle, roughly speaking. So in essence, if the S&P, by the way, I didn't talk about the S&P target, but the fifth wave in the S&P should reach 4,200, maybe a little higher. So for now, it's about 4,200 on the S&P, 35 to 36,000 on the Dow, and about 2,600 on the semiconductor index. The NASDAQ 100, it actually began, the bull market began right here on the heels of the 2000 or the post-2000 crash, the dot-com bubble burst. When it popped, what happened? And let's forget about the pink count right now. We'll revisit that years from now. But at the bottom of this bear market that began in 2000, a new bull market began with wave one. Financial crisis was a zigzag. Wave two, it retraced 84% of wave one. And then wave three ended in February 2020. It was a breathtaking move. And the fourth wave, I believe, ended here last week. Why did it not go all the way down to the bottom of the fourth wave, you might ask? Because wave two was so deep, almost 100% of wave one, retracement-wise. That's why the fourth wave was relatively shallow. Are we going back up like this? Absolutely not. I think we're going to chop around a little bit, and to build a base, it's called the basing process, and then the red fifth wave will get underway and will take us to new highs. I'm not going to set targets right now. I didn't work on that for the NASDAQ. Plus, targets are always subject to change. Okay, I can't just come up with targets out of the blue. I will have to track what's going on using my valuation model, which is part of the tri-model framework. Tri-model meaning three models working in conjunction with each other. You have the technical analysis model, which is what I'm doing. The valuation model, which tells me whether the market is overvalued, undervalued, fairly valued, and then I have the buy-sell model. That's the model that triggers buy and sell signals. Those three models work hand in hand. So, once we confirm the start of the fifth wave, I'll start doing the technical work, the valuation work along the way, and I'll track it because remember, technical analysis is an ongoing thing, or market analysis. It's an ongoing endeavor. You have to fine tune it along the way until you close in on what is most likely to happen. All right, I can't start making crystal ball predictions right now, calling for exactly where it's going to top. I mean, what I'm doing here is enough prognostication for anyone to, cast a doubt on what I'm saying, because I'm predicting what's going to happen. What just happened, calling the bottom, and then telling you we're going to go to new highs, and then telling you we're going to crash afterwards. If that's not enough prognostication, I don't know what is. All right. And please note that I'm not using the movements of planets and the movement of the oceans and all that crap. I'm really doing sound technical analysis here, knowing what I know. All right. Now, the NASDAQ composites. By the way, there's something I wanted to discuss about the NASDAQ 100. Do you recall the 2011 summer swoon? Look at the base right here that formed from the top of the market in 2008, starting at the top of the market. You had a base that formed. You see that? The 2011 pullback tested this. I didn't draw the line straight. Let me try to draw it a little straighter. Here we go. This is what we tested in 2000. All the drama in 2011 came down to a back test of this support level, the neckline of this head and shoulders continuation base. All that drama. Now, that's why I told you to not dismiss what I'm saying, because just like the NASDAQ in 2011, the SOX is doing pretty much the same thing. Broke out and came down to test this level a little lower towards the bottom of the fourth wave. Didn't get down there, but look how fast it was rejected. We're back here. Okay? Same thing, only a little more dramatic. All right, let me get back further down the road here. Where was I? NASDAQ. Okay. I was talking about the NASDAQ composite. Same exact picture as the NASDAQ 100. First wave. Second wave was 88.6%, right on the head. It had a zigzag right here in the second wave. The third wave ended in the vicinity of the 461.8 to 476.4 projection, meaning that third wave was almost 5 times as big as the first wave. Typical, okay? And because wave 2 was deep, 88.6%, the fourth wave was relatively shallow, about 38.2%, never got down to the fourth wave, the prior fourth wave, because that would have been a little too deep, okay, compared to the second wave. Again, principle of alternation. Now, where did it bounce off? It bounced off the 50 months moving average. That's what this green line is. So it was a mean reversion move, as dramatic as it sounds. And because of my forecast, that's why I'm seeing light at the end of the tunnel as far as this virus is concerned. Okay? When I told you in June 2019, the cycle that began 10 years ago is about to end for reasons unknown. I'm going to say right here that this phase of the super cycle is about to end for one reason, and that is that the COVID 19 virus, or not virus, disease, COVID 19 is the disease, coronavirus is the virus, this whole fiasco, which of course cost thousands of lives and a lot of despair, of course, a lot of misery. It's about to come to an end. All right. So I'm sure that some of you might be thinking this guy is way too gullible. He's using the stock market to predict the coming end of this disease that has cost thousands of lives and has infected hundreds of thousands of people. But just like Wyckoff, the great Richard Wyckoff, one of the greatest technicians of the early 20th century, I do believe, and I think he might have called it the compounding man or something. But if you look at the whole market as one very wise person, I call it the collective wisdom of the crowd, meaning when you have millions of people making buy and sell decisions, you have to believe in the chart patterns, because the chart patterns reflect that wisdom. And millions of people are infinitely more or infinitely wiser than any one of us. Okay? Anyways, that's all I got as far as this update is concerned. Please do me a favor, share this video. Like my tweets on Twitter at Peter Ghosteen. Again, share this video and subscribe and like it on the YouTube channel. I appreciate you watching it, and until next time, have a great day.